Welcome to the Strategy Skills podcast. Our podcast sponsor today is strategytraining.com. If you want to strengthen your strategy skills, you can get the overall approach used in well-managed strategy studies. It is a free download, and you can get it at firmsconsulting.com/overall approach. And if you're currently updating your resume, you can also get McKinsey and BCG winning resume, which is a free download. It's a resume that got offers from both firms, and you can get it at firmsconsulting.com/resume PDF. And today we have with us Rick Ruback and Royce Yudkoff, who are professors at Harvard Business School, where for the last 14 years, they have taught thousands of students about entrepreneurship through acquisition. And that is the type of entrepreneurship that people not often talk about, and many people not considering it as an option. They have also written the leading how-to book about this subject and have recently started a podcast produced by Harvard Business School on entrepreneurship through acquisition called Think Big, Buy Small. Very nice title. Welcome, Rick and Royce.
It's a delight to be here.
Thank you for having us.
Let's start with current trends in the market or economy that you think are impacting entrepreneurship through acquisition. And then I want to go through the process step by step.
Sure. Rick, do you want to start or would you like me to?
Sure, I'll take the easy spot.
Okay.
High interest rates also obviously make it a little more difficult to finance acquisitions. Many people use small business administration loans or commercial loans to finance between 50 and 90% of their business acquisition. And of course, the higher the interest rate, the harder that is. In the case of a small business loan, there's no covenant. So that's more of it's more expensive to pay it back problem. In the case of commercial loans, though, there are usually covenants, and the high interest rates make those covenants just substantially tighter. So that's one. I took the easy one, Royce.
Thanks, Rick. I think that's certainly a really good one. I guess another trend I'd comment on is demographic, which is, we're midway through the baby boom retirements, and particularly for owners of small businesses who tend to work a little longer than people who are in other people's companies. And so you've got this bulge of people who are now 65 to 75 years old. They own small companies. Their children, for whatever reason, aren't interested in being in the business, but want to follow another career, and they're compelled to sell these companies. And so there's just what's been referred to as the gray tsunami of baby boomers who really need to get out and find a buyer who will run the business. I think that's another important trend.
So glad you brought it up, Royce. And Richard as well. Thank you so much for bringing up interest rates. Both are crucial things to talk about. So with baby boomers retiring and interest rates being high, so taking loans not as easy as it was, do you feel that now there will be a lot of businesses that just people will not be able to sell?
Oh, I don't think so. I think the businesses will still sell. It's just a question of what the price is. The price is there's going to be likely some downward pressure in pricing, as there has been with the higher interest rates over the last few years. So I think, I think there are certainly some businesses which are really jobs, and those are hard to sell. But for people who have real businesses that are profitable, I don't think there'll be a problem. It's just going to affect perhaps the pricing.
And also, it's very common with small companies for the seller to take part of the sale proceeds in the form of seller paper. So that's another way when you have to shrink the amount of, say, bank loan that you get because of the interplay of interest rates and covenants, the seller might step in for a larger chunk of subordinated seller debt to supplement Rick's point about, bringing the price down for the new buyer.
I heard that about 80% of businesses are not sold. They just disappear.
Yeah, I don't know if that's right, but I think a lot of businesses are just jobs. And if it's just a job, it's really hard to sell your business if your business doesn't exist beyond the job. And sometimes is the human, and the human capital is just tied to the business so tightly and the skills of the owner are just tied so tightly. It's really hard. to transact. And sometimes you find the exact same thing on the real estate side, that the real estate is tied so tightly to the business. It's hard to sell the business without selling the real estate, and then what's the right pricing? So I don't know what that number is, what percentage of businesses just fold up their shop. But certainly some of those businesses are jobs, not businesses. Think about the electrician, the plumber, the tradesperson who has, maybe two trucks and four employees, but they're the ones with the license, right? It's hard to sell that business.
Yeah, and Rick and I don't encourage anyone to buy businesses that small or businesses that are really jobs, as Rick says. But if you look at the sort of next tier up of small companies that uh, generate a pre-tax profit somewhere between $500,000 a year to $2 million a year, every year, tens of thousands of those companies are sold in North America alone. So that's a sort of statistic we like to look at because what it says in words is that there's an enormous number of appropriate to buy companies relative to the number of people who are pursuing entrepreneurship through acquisition.
So much to cover. Let's go step by step. So let's start with how can someone know if entrepreneurship through acquisition is for them? What it generally takes and what kind of entrepreneur will succeed in this role?
Wow, that's such a hard question. I only wish I knew the real answer to that question,
Well, I'll start with part of the answer. Part of the answer is that you're someone who works in someone else's company and you're doing okay, or better, but you're just not feeling happy and fulfilled with your work. You look at your bosses and say, it wouldn't thrill me to have those jobs. And usually those people also say to themselves, but the problem is I don't have a big idea or I'm not a technologist. So the idea or this idea of starting a company from scratch is just frighteningly risky. So those attributes that I associate with startups don't work for me. That's the starting point, I think, for searching for a business to buy because it's lower risk. The business model is proven. And yet this person has anywhere from 7 to 15 years of skills in the workforce that would translate over into running a business. I think that's, Rick, I think that's one of the characteristics that is foundational for being interested in going off and doing this.
Yeah, I think that's right. I also think, though, that there's a core level of commitment and creativity and energy that people want to bring to this activity. That independence. They want people who want to write up their own to-do lists every morning, not having somebody else give them a to-do list every day. Those are the people I think who thrive at this. So I think you have to ask yourself, am I independent? Am I comfortable with executive responsibility? Am I comfortable with having people like me or be mad at me? Do I want to, my job is not going to be everybody's friend. My job is going to be, how can I make this business more financially successful? So the charming golf buddy might have to go if he or she isn't productive. So I think you just have to say, do I want that executive responsibility? Is that something that I want in my life? And many people do, but there's a certain virtue to knowing that I have this job and I wake up in the morning and somebody else tells me what to do and I start at 7 o'clock or 8 o'clock or 9 o'clock and I finish at 6 o'clock, 7 o'clock, 8 o'clock or 9 o'clock. But when I'm done and I go home and nobody's going to call me and say, boy, the oven isn't working in the bakery. What should we do? Or whatever it is, there's water coming through the ceiling. There's an unhappy customer. What do I do? One of our podcast episodes from our podcast that just continues to resonate with me is we interviewed a woman who owns a pool company in Long Island. where, the requirement is that the pools be perfect on Memorial Day. And she described a situation where, they had just cleaned the pools, they had just taken pictures of it, it's just beautiful. And then 2 hours later, the people arrive and the pollen has floated in the air onto this person's pool. And the customer calls up irate that the pool has pollen in it. And you have to be the kind of person who says, right, let me take care of that, not what a jerk this customer is. Right. And so that's that's a skill set.
I agree with all of that, of what Rick just says. I'd add a few things that actually are not on the list, because I think they're things people who are contemplating entrepreneurship through acquisition would say, gee, do I need to have that? The first thing that's not on the list is previously being the CEO of a company. In the 14 or 15 years Rick and I have taught this and studied this market, virtually no one who leaves a job and goes to buy their own company has ever done that before. So they're all first-time CEOs. They all have some kind of business experience, but first time, no prior experience CEOs. The second thing you don't need.
And they don't all necessarily have business experience. A lot of people who've served our country in military capacities, they've not had a P&L. They've had jobs, but not jobs for other businesses. They don't have any business experience, but they're great CEOs.
Yeah, and they've had managerial experience in the military, right?
Of a different kind, right?
Of a different kind. And that's just to build on that point, we do notice people who do this successfully come from all different professions. Yeah. They're engineers, salespeople, consultants, finance types, military officers. And the reason this works for people who haven't been CEO and come from all these professions is because of at least two things. One is when they're diligencing a company, they look at what the current owner CEO does, and they sensibly ask themselves, could I do that? Could I see myself doing that job? And if the answer is no, I could never muster those skills, they don't buy that company. They buy a company that they can take that job with a proper transition period. And that's the other piece, that almost always in these kind of transactions, the exiting seller agrees to a 3-month, a 6 months, we've even seen as long as 12 months transition period to sort of, hand the history over and teach the buyer. So all different types of people do this.
Let me add one more to Royce's list of things that are not required. One is an appetite for risk. You do not have an appetite. You do not need to have an appetite for risk when you buy a small business. In fact, the more you hate risk, the better a searcher you're likely to be, because you can buy a business that has recurring revenues and has been a successful business under the prior owner for decades. That's not a risky, but you can look and see how the business has done in the Great Recession, how it did during COVID. You can look and say, wow, is this business volatile? Is it not? If it's volatile, don't buy it. So you don't need that. You don't need that predilection to skydive to be a small business buyer. And furthermore, I would say that most corporate jobs have a lot of risk in them. The risk is just hidden from you. You don't know that the guys at the corporate headquarters are up sharpening the guillotine until they pull the rope. And say, hey, guess what? Your division is no longer going to be employed. The day before, the morning before, if you ask your boss, is everything okay? Some weird stuff. These moving trucks are coming up to the business that I'm worried about. Everything's perfect. Nothing to worry about, right? So there's risks you can see and risks you can't see. And I would argue that there's lots of risks that you can't see when you work for somebody else, and risks that you can manage when you work for yourself.
Let's talk about finding the right businesses to buy. Before we talk about funding, let's talk about finding the right businesses to buy. Which sources to use and how to filter prospects. And I specifically wanted to ask, when it comes to baby boomer businesses, if you want specifically to buy from baby boomers because of what is going on now with so many of them trying to sell and interest rates are high, so not that many people are buying, how would you adjust your search?
Rick, do you want to take one of the two paths of searching? I'll take the other of sourcing deals.
Sure. The most standard way of finding a business to buy is through the network of brokers. Brokers find committed sellers, that is, sellers who have made the decision to sell. They've spent a bit of money, usually to retain somebody to put together sale documents. The sale documents are thoughtfully put together. They might be optimistic, but they're thoughtfully put together. And you can learn a lot about the company pretty quickly. And you know that if you and the seller agree on price, you have a reasonable shot of closing this transaction because they've already committed to sell. They've already convinced somebody else in an informal, non-adversarial conversation, the broker, that they actually want to sell, because the brokers don't want to spend their time on uncommitted sellers. So that's really, there's a lot of virtue to using the broker network. Not everybody does. The second path, Royce?
The second path is known as direct sourcing, and this fits particularly well if you're doing a scoped geographic search, like around the city you live in. And that is to sort of directly reach out to owners of smaller firms. This is typically done by mass email campaigns, but it's also done by showing up at meetings of local business clubs or networking through attorneys and accountants to get to business people, or just cold calling them when you see an interesting business and saying, I'm an entrepreneur who wants to buy one great business. Might you be interested in selling? It's a very difficult path because, not surprisingly, you get a very low rate of yield. But to those people, it's been the best call they've gotten all month. And you're trying to find that seller who wants to sell but doesn't quite know how to get started on that process. So those two ways are the ways that are employed by most searchers: the broker way that Rick outlined and the direct sourcing way that I just described.
And would you say that if you go with the sourcing option, direct sourcing, you would generally get a better deal because you're not pay broker fees?
No, the seller pays the broker fees, but if you're buying the size businesses that Royce described earlier, the $500,000 to $2 million of pre-tax profits, those businesses are not big enough to attract lots of interest. So, the broker might say they have 10 interested parties, but they're probably all 10 of them are you. And so, there's always this risk of bidding against yourself. But generally speaking, in this size range, we don't think that there's really the effective kind of auctions you see in bigger companies that move the prices dramatically up. And second of all, in direct source businesses, one of the things we have seen far too often is the buyer and seller will agree on a price that makes the buyer very happy. Maybe it's a low multiple, maybe it's off-market terms that are helpful to the buyer. But by the time closing comes, and sadly, it often occurs like the week before closing, the seller will at some point reach out to some professional who knows more about the small business market than the seller does and say, hey, I'm about to sell my business. These are the terms. Do they make sense? And if that person says, no, they don't actually make sense, the price is too low, this is off market, that's off market, you've got to get this done, you've got to do that, the deal might well go sideways, or many deals just break up at that point because you have to renegotiate price. And, it's not that you can't renegotiate price, but when you renegotiate price after you've raised the equity and after you've raised the bank debt, now you have to go back to all your investors and say, oh, by the way, the deal has changed. And the new deal is probably not going to be as good as the old deal. And so, poof, the deal blows up. And so I think direct sourcing makes a ton of sense, but not because you're trying to get a lower price. It makes sense because you're looking for something, a needle in that haystack of a small community. And so you have to talk to every business owner in that community. You're looking for a particular kind of business in a particular industry. I want to do this kind of healthcare business. I want to buy dental practices. I want to buy, concierge medicine practices. I want to buy Botox clinics, whatever it is that's so specific. The brokerage network is just kind of being an inefficient way to find them. It's much easier to just get the list from the national Botox clinic, or whatever convention, and get that list and call all of them.
Makes sense. And I know what you mean. So I was thinking, as a seller, if you don't pay a brokerage fee, then you can sell. Basically, you don't have to take it into account. You maybe offer a better deal to the buyer, but you are right. Brokers actually can speak with the seller and explain the multiple is too high. So it all evens out, and
Right.
there are challenges with direct sourcing. When buying from baby boomers, are there additional things people should keep in mind in terms of looking for those businesses and evaluating them?
Well, Rick and I always advise searchers to buy what we call enduringly profitable businesses. That's actually an expression Rick came up with many years ago. And what we mean by that is you're looking for a few characteristics that tend to result in safety for the business and the likelihood of growing profits. And those are, first, that this business has recurring revenues. In other words, the customers buy from them again and again and again and again because it's in the customer's interest not to switch. Maybe it's expensive to switch vendors, or there's a lot of risk to switching vendors, or it's an unimportant cost to you as the customer, and so it's not worth a lot of time looking to switch vendors. Often it's a cluster of these reasons. So one is, people should look at how much of the revenue is recurring as opposed to businesses where once you serve a customer, they're gone and you have to replace them. A second quality is that the businesses aren't cyclical with the economy, that when the economy goes up or goes down, the business's sales tend to be relatively steady. So that would be a second characteristic. Third, one of the benefits of buying a business as opposed to starting one is you can look back in history, and Rick touched on this earlier, and see how it performed for years and years. And so if this business has been profitable for 15 or 20 years, that's a really good clue that it's going to be profitable in the future. And all of these things are and one more I'd say is low customer concentration, that you're not dependent on any 1, 2, or 3 really big customers. Because when you have that, in many ways, you just have a job. You work for those customers. So those qualities are perfect filters for as you go out and look at businesses, because they're important and they're readily knowable. So Chris, as you ask, what should people look for? This is the first set of filters that Rick and I would advise applying. Rick, I don't know if you'd add anything to that or modify
No,
that.
I was thinking about whether there's something specific around baby boomers that, which I think was part of Chris's question, that's special. And I would just say that, when you buy a business, and particularly after you've agreed on price and you're starting that period from signing the letter of intent to getting ready to close, most sellers always say, I really want that to be 60 days. And they don't know how much work there is for the seller to do. The seller doesn't know how much work they have to do. Turns out the seller has to do a lot of work. They have to prepare schedules. They have to think about how that's going to align with their own financial plan. They have to do some tax planning. They have lots of stuff, and they have to do all that stuff while they're still running the business. And so I think I'm a baby boomer, right dead smack in the middle of that group that Royce talked about, and I will just say, it's harder for a 70-year-old to get stuff done than it is for a 40-year-old to get stuff done. And so, if you're buying a business for somebody who's 70, 80, 85, you just have to be more patient with the closing process. The closing process is going to take more time, and there's a little bit more frustration. Chances are, if the person is, say, 70 years old and they're selling the business, they might have owned it for decades and they're preset in their ways, and you gotta kind of work through that. And as I say, it's a spot where kindness and patience really pays dividends.
Would you say that most baby boomers don't sell via brokers? Because when I was looking at different businesses for sale, I haven't seen many that are sold by baby boomers, but I know that a lot of baby boomers want to sell their businesses.
Yeah, I think if they want to sell their businesses, they sell it through brokers. But I think, um, there's like so many things in life. You're going to start the diet tomorrow. All these unpleasant tasks, you have a good reason to postpone till tomorrow. And so I think, people want to start their exercise program tomorrow. So I think that what you're seeing is not so much this reluctance to sell or reluctance to use brokers, but just this difficulty of moving to the next stage of your life. That's number one. Number two is, they might do some calculations, and if they do some calculations, if they're making $1 million a year in pre-tax profits and hiding a lot of that from the IRS, and I'm sure perfectly legal ways, uh, they're earning a pretty good living. And then when they take that money and sell the business for $3 or $4 million and invest it, they're probably going to earn at most 10%. It's a reasonable expected return, maybe a little
Mhm.
better, but these days because of the inflation, but certainly the real rate's not going to be 10%. It's going to be more like 5%. So they're going to take their $4 million, they're going to make $400,000 or $200,000 real, and they're still going to have to pay taxes on that. And their ability to shield those taxes have gone down. So some owners look at that calculation and say, "Wow, I'll just hold on to my business for one more year. I'm healthy enough, and unless I'm compelled to sell, I'll hold on because I'd rather have $1 million in pre-tax dollars than $400,000 in pre-tax dollars."
Richard, and you brought up something very important that I want to highlight for our listeners, and that is that small businesses have relatively low multiples, so they're more affordable than people realize. So you mentioned 3 to 4 times multiple. At what point, in terms of the size of the business, the multiple is not as attractive?
Well, it starts going up, particularly after you get above $1.5 million in pre-tax income. And certainly by the time you've reached $5 million in pre-tax income, the multiple is based less on size and more on the risk characteristics and growth opportunities and things like that, characteristics of the business. But certainly at the small end, say $1.5 million or less, the multiples are going to be in the 3.5 to 4, maybe 5 if it's a great quality business. But that's really it.
Very important to know. So once you get to 1.5 million to 5 million, what kind of multiples people can expect approximately?
Well, like Rick said, it depends on the quality of the business, but you're going to be up in the 7-8 times range as you penetrate that higher level. And there are a lot of reasons for that. One is that as the businesses get larger, they attract a whole bunch of new buyer competition, like private equity firms, for example, that help to bid up that price. That's one of the things that makes small firms so attractive. We like to say the magic is in the multiple, right? Because if you buy $1 million pre-tax profit business for $4 million, every year it's spinning off $1 million before you even grow it. That's a 25% return. That's pretty good, right? That's a pretty good return. So
Put some leverage in SBA debt. Life's looking great. But yeah. And it also really depends on the quality of the business. We've seen recently some businesses that are less fancy, maybe less recurring revenue, more project-based instead of recurring revenue, but project-based businesses that have, 2.5 or $3 million of pre-tax profits that are selling at the 3-4 times range because the quality of the business is not the same.
Richard, you brought up SBA debt. And as far as I know, from what I heard, I haven't looked at it in detail, you have to personally guarantee if you take SBA loan. Do you
Right.
feel that it is still worthwhile to look into it?
Oh, yeah. I mean, because if you think about it, first of all, the small business administration loans are wonderful because there are no covenants. So if you take a commercial bank loan, every quarter you're going to have to report to the bank how various financial ratios look. And if the ratios get tight, the bank will ask you to repay the loan, might ask for a penalty, you're going to have to ask for a waiver. There's going to be a lot of your time is going to be spent on managing to the loan. Whereas with the Small Business Administration, there are no covenants. You just have to make sure you're paying the promised payments you've made, the interest and principal payments on schedule. And as long as you pay those on schedule, SBA is pretty happy with you. So that's a big difference. So the personal risk of having a bad outcome with a commercial loan is just much higher because of the covenants. But second of all, the SBA, the other thing is that the SBA is, suppose the interest rate's 10%. If you're buying a business so let's go back to our example. You're buying a $4 million business. You're buying a business for $4 million that has $1 million of pre-tax profit. So suppose what would be reasonable? $3 million, Royce? $3 million. So you have $3 million of debt, which means your interest payments, if you paid 10%, 10% is so easy. Finance professors love 10% because we can do the math so easily. So now I have to do it right? So $3 million means the interest payments will be $300,000. And maybe there'll be some principal payments in the early years as well, small ones, because the SBA does level payments, but let's not focus on that. So maybe it's 350, whatever it is, $350,000 of total payments. That means the profitability of the business would have to drop by 2/3 or more than 2/3 before you got a problem. That doesn't seem to be very risky or very likely to me. So that's not a big deal. And most people who take out SBA loans don't have a lot of assets to begin with. And then thirdly, the SBA doesn't want to take your house or your car or your kid's crib. What they want is to not get left with the keys to a business that isn't working that you just walk away from. So most of the time, if there's something bad happening, the SBA is going to work with the bank is going to work with the entrepreneur to come to some equitable settlement that makes it all work out pretty well. So if you look for instances where the personal guarantee actually turned out to be an albatross around somebody's neck, you're going to have to look really hard for that.
Thank you. Thank you for sharing this. So let's talk about brokers. I think that now that we spoke about multiples and that small businesses are actually much more affordable to buy than most people realize, many people listening to us now thinking, okay, where do I go to look for a business? What would you guys recommend?
Well, brokers are not hard to find. These are people who want to be found. They're not secret agents who don't want to be found. And so the first place I'd start is just by Googling small business brokers, or if you're doing a geographic search, small business brokers in your particular community, and you're going to start to come up with 5, 6, 10, 50 of them, and start reaching out to them and describe what the characteristics of the business are that you want to buy, the size. If you have, some broad industry preference, like I want it to be service businesses that sell to other businesses or consumer businesses. So I just reach out to some brokers. There are also some online marketplaces, and often owners or brokers will list there, and that's a very easy way to do your shopping. So Biz Buy Sell is one of several online brokerage network. You can just go on and literally page through their listings. So those would be the two ways that allow someone to get started. And equally importantly, to start to sort of look at a flow of small companies and see what they look like, which is a good place to begin your search, is just bathing in the choices that are before you.
For someone who is a professional, business professional, maybe they are management consultant, a banker working for a large tech company, they're listening to us now and they're thinking, this sounds like a very good idea. I need to start looking. What kind of business would you recommend they start looking at?
I think they need to decide whether there are constraints on their search. Is it a case that they're committed to a particular region of the country? Do they have elderly parents that they don't want to leave? Do they have kids in school that they don't want to disrupt? All those things. So they need to figure, or is there an industry in which they're deeply committed to? I want to do healthcare. I want to do life sciences. I want to do engineering. I want to do aeronautics, whatever it might be. And those constraints really determine how they search.
What are some of the things people should keep in mind when they're searching for a business that we haven't discussed yet? Maybe some key errors that you noticed people make.
Well, I would offer one or two, and Rick, I know you'll jump in on this. One key error when they're searching for a business is they forget that just like they're a first-time business buyer, almost every seller is a first-time seller. And that means the seller is learning as they go. And one of the biggest pieces of learning for a seller is, what is my business worth? They're taking their biggest family asset, they're doing something with it that they've never done before. And so many sellers will start that journey by pricing the company very, very, very high to see what the market will bear. And so you're encountering sellers at all different stages of their journey. They're just starting and the price is way out of market. They've had some experience and the buyers who have looked at it said, no, I'd never pay that price. And they're bringing the price down to a fair market price. And so one of the early things you need to do as a buyer is test what the seller's price expectations are, because these are not professional owners of businesses who are constantly in the market for buying and selling companies. And so that means if you're dealing through a broker, you'll get a book on the company and you'll read about the company in that book. You'll set up a call with the broker or owner and you'll ask them a dozen questions that you have after reading that book. And then somewhere about there in the process, you want to signal to them the price range you're thinking of and saying, this is kind of what I think I could buy your company for. Should we keep talking? And at that moment, you're going to find out that the owner is expecting a price 3 times as big, and you move on without having spent a lot of time. Or they say, that's a little low, but we should keep talking because you're close. And that's a signal that you should go forward. So rookie buyers make the mistake of pouring in way too much work before they administer a price test. That would be one thing I would say that buyers should be mindful of when they come into this market. Rick, I don't know if you'd add something to that list or.
Yeah, well, it's just a different version of the same, which is people fall in love a little too early with businesses. They read it, they imagine themselves owning it, they imagine what life will be like living in this particular community, they look at real estate on that community, they do all kinds of things other than note that the business hasn't earned any money in the last 5 years, right? So there's a sense of being a cold, dispassionate evaluator of businesses that as Royce says, you have to get to know relatively quickly. This is a time game, right? You have lots of businesses to potentially to look at. Even if you're looking at a tight geography, you might have hundreds or thousands of businesses to look at and give just a cursory look, perhaps, to most of them, but to look at. And the more time you spend with bad prospects, the less time you'll have to spend with good prospects. So there's no time pressure in the sense there's nobody at the end of the day with a clipboard saying, how many people did you talk to today? How good was that? You shouldn't have done that shit. Right? So you need that level of personal discipline to say, okay, this one just, I would love, I like buggies and I like buggy whips, but I don't think there's much market for buggy whips. So I'm moving on.
Makes sense. Can we clarify buying a job versus buying a business? How can people know which one they're buying?
Well, I guess I should go first because I offered that early on in our conversation. A job is something in which all the organization is designed to support the owner in their work. So it might be yeah uh one of the ones I remember through the years was that specialty metals company. Remember that, Royce? Where the guy had inventories of all specialty bizarre metals, and he would keep them in inventory and sell them. So if you needed a hatch for your submarine, you'd call him with your needing whatever it is, titanium or this or that, whatever the specialty metal is, and you'd call him up, and he knew how much he had in stock or what the right metal was for your submarine hatch, and where to get it if he didn't have it. And as all this information was about him because was a metallurgist and he knew lots about metals. Now, I couldn't buy that business because I don't know anything about metals. I know when I chew the top of my pencil, it doesn't taste very good when I get down to the metal pot, but that's it. That's all I know about metal. And so, you need to be able to imagine that the business can transfer. And if the business can't transfer, obviously, and in an obvious fashion, and that all the organization is built around to provide leverage to the single individual who happens to be the owner, then that's a job. I think that's fair, Russ?
Yeah, no, I think that's right. Most of those businesses that are jobs shut down when the owner retires and the few assets are sold off. Businesses are things that the owner can leave and someone else can step in and it continues to perform.
Right. Right. Now, there's some interesting examples of transitions. Like, for a long time, dental practices were jobs for the dentist and an entrepreneurial opportunity for the dentist. So there'd be a dentist, and there would be maybe he would have a dentist or she would have a dentist. In this case, in the case of dentists, they were mostly men. If you go back 30 years, and the dentist might have one or two employees, might have an office manager, might have a hygienist, might have another dentist, but the dentist was both had a job and a business, but you couldn't buy the business without being a dentist. Because how could you run a dental practice? How could you start drilling? Who would want to do that, right? Seems creepy. But what's happened is in the passage of time, whereas in my generation, many dentists were men, most dentists were men. In the current generation, if you look at dental schools now, most of the dentists are women. And for whatever reason, the women think about being a dentist as a job. That is, they want to practice dentistry, but they don't want to run the business. And so now you find people buying up dental practices who don't know anything about, they're not dentists. They're MBAs. They're buying up dental practices, running them as a group, and hiring dentists to drill the teeth and put in the fillings and the caps and the whitening and all the other things dentists do. So you do find those transformations sometimes where jobs become businesses, but you need some fundamental shift like the demographic shift among the population of dentists.
Another question I think very important for us to address is how can someone determine if they should buy a very, very small business with their savings, let's say up to $1 million, or use a small business loan and go for a larger business, maybe $3-4 million? How would someone make that decision? What would you recommend they consider?
Well, I would say that buying a good quality business is the most important thing because your time and energy is very valuable, and a lot of the outcome is determined by the quality of the business, much of which is knowable, right? You can look at the history of the business's profitability and all these characteristics we've been talking about enduringly profitable businesses. The money to pay for it is really not that much of a challenge. In the United States, As Rick was describing with SBA loans, the federal government will lend any American citizen up to $5 million to buy their own business, and they'll provide up to 90% of the price of the business. And frequently, the seller of the business will take back a seller note for some portion of the business. And some tiny amount of equity is therefore all that's needed. So usually the constraint is not the buyer of the business coming up with money. The constraint is doing a lot of the work we've been talking about in this conversation to find that good business at a reasonable price. So I would answer that question to say, buyers shouldn't focus on some small business driven by their personal saving. They should look in this range of businesses we're talking about and find a really good business that they feel comfortable with a transition plan running for taking over from the owner, and the financing can be put in place through these mechanisms.
Thank you. And then another question I wanted to ask you, and that will be, what key errors you see buyers make when it comes to deal structure, financing, timing, other fundamental points related to deal terms, maybe something we haven't yet discussed today?
I'm happy to take that one, Royce. Buyers often live in their business, and so they have these complex things, that have a sublease to this person, to that person. They have money that they're building a swimming pool with, or whatever it is that they're.
Rick, you said buyers, you meant sellers live in their business.
Right.
Sellers.
I'm sorry. Yes.
No,
sellers live in their business.
Mm-hmm.
And sellers have all these unrelated expenses. And one of the things sellers tend to do is they tend to get really complex. They're really eager to avoid taxes, as we all should be, but in legal ways. But they often make things really complex in that process. And then when somebody goes to buy the business, they say, well, our pre-tax earnings were $12, but there's another $1 million of add-ins that, you should add back. Because it's my, cousin's cars and this and that. And at some point, most buyers will throw up their hands and say, I don't know what's real here. This is kooky. So I think keeping things simple and preparing for sale, making sure your accounting system makes sense, making sure you have numbers available, making sure that your workers, if they're W-2 workers, are getting W-2s and not 1099s. There's some basics that your sales tax is being paid. Some basics things that make the business easier to transact, and some things which have short-term benefits perhaps to the owner, but make it and the eventual seller, but make it very, very difficult to sell your business. Look, if you have a bunch of employees who are really employees, but you treat them as consultants and pay 1099s instead of W-2s, that business, you may save some, if you're not caught at that, you might save some employment taxes, but you might not be able to sell your business because the buyer, if the Department of Labor comes and says, hey, these workers were W-2 workers, not 1099 workers, you owe all these back taxes, that goes not to the time you bought the business, but all the way back to the inception of the business. So for many businesses, these, I don't know, what do you want to call them? Shortcuts or being overly clever with your tax management or cutting corners. Sometimes it makes it almost impossible to sell your business.
And from the buyer's side, I guess you have to be aware of all this messiness and that you may be taking on some liabilities. And then maybe in that situation, maybe you could buy assets instead of a company or something.
Doesn't work. If you buy the assets and your employee should have been W-2 and not 1099, the fact that you bought the assets does not prevent the government from coming after you as the new owner. So there's no way to hide that problem. The only way to hide that problem is to have that problem cleaned up by the seller before they sell.
The good news is that if you work with a accountant and a lawyer who have done small firm transactions before, they're going to have a checklist and they're going to march through a lot of these items so that you may not end up doing the deal, but you're not going to get stuck with that liability without knowing you're getting stuck with that liability, because one of your advisors will probably stop you along
One of
the
the
way.
buyer's advisors.
One of the buyer's advisors will stop along the way. Yeah.
And similarly, the seller, if they retain a broker, the broker will go through a long checklist and say, well, tell us about this, tell us about that. And they might say, look, you need to take 3 years to fix this problem, and then we'll bring you to market because you got to get your accounting right. And it's not unusual for firms to approach a broker and then have 18 months to 24 months before they actually go on the market, because there's some work to be done to make the firm ready for sale.
So the liabilities is something people need to be very careful when buying a business, what kind of liabilities you're taking on. And the lawyers and accountants come in.
Yeah, so short-term greed is not always the right thing. Sellers are often, it's not that they're short-term focused in their business, but when it comes time to paying taxes and doing some other things, they often manage their businesses in ways that make it very hard to sell.
I know we are almost out of time. Do you guys have a few minutes for the last quick question?
Sure, go ahead.
So the question we often ask at the very end of the podcast is, over the last few years, what were 2-3 aha moments, realizations that you had that changed the way you look at business or the way you look at life?
We should have said we didn't have time for this last question.
That's very funny. Well, I'll offer one, and Rick, this is my gift to you because it'll give you a minute to think or so.
Take a long time, Royce. Give us one of your long answers.
No, Chris, when Rick and I started teaching in this area for 14 years ago, one of the things that was a big aha moment for me is I realized how many great small businesses there are in the United States that some talented entrepreneur has created and provides not only a fantastic living, a living that makes that family wealthy, but a great life for that owner professionally and controlling their own destiny and controlling their lifestyle, which is to say they might work hard, but they work hours and days that they want to work. And if they need to be at their kid's soccer game on a Wednesday afternoon, they can do that. There's no one to say no to them. And that there are just thousands and thousands and thousands of these businesses that are quietly operating that I had never really appreciated before we started studying this. And so that was a huge aha moment, that there's so many ways to have a great professional life in the world of small businesses. So that'd be one for me, Rick. I don't know if
yeah, I would just add to what you said first, which is like every day I learn of a business that I didn't know existed before. Not just the name of the business, but that you're kidding. There's a business that actually does this very specialized arcane thing and does it so successfully and makes money at it. It's great. Big aha moment. Well, I think the big aha in small business was really about the multiples. That the multiples are just so attractive, and it's not that they're attractive, and this is like buy it now before, like the used car salesman, right? Buy it now. This deal isn't going to be there tomorrow. What Royce and I have seen is the multiples have moved a bit through time, but they've moved through a very narrow range. And the reason they've moved through such a narrow range is that these businesses need buyers that have two things. Generally, one is that they have the managerial skills to run the business. And two, they have the ability to raise the capital to buy the business. Private equity firms can't do that. They can't manage the business. They can raise the capital to buy the business, but they can't manage it. So searchers bring something very special to the table, and they get rewarded by buying these businesses at relatively small multiples. So that was, I think, my biggest aha, and maybe my second biggest aha moment was that when you compare careers if you compare careers and say, okay, if I go and work for a major consulting firm, or a major accounting firm as a consultant or whatever, or a corporate job, what's my likely income and what's my likely payoffs? And you just kind of trace that out. And you can do that. You can do that for like Harvard MBAs on average or MBAs on average. And then say, well, okay, so a really successful person with an MBA degree is making two, three, $400,000 some years out. But then you look at somebody who buys their own small business and they're leading a relatively dull life. They're doing something dull. It's not very exciting, but they're making more money and living a much better life. They have this flexibility that Royce alluded to. So I think there's this fundamental thing, right? That small business may be short on prestige, but long on both income and quality of life.
Thank you. Thank you, Royce. Thank you, Richard. I really enjoyed our discussion today. Where can our listeners learn more about you, buy your book, anything you want to share?
One of the things we're working on currently is a podcast on buying your own business, and it's called Think Big, Buy Small, and you can get it wherever you listen to your podcasts. And then we have a book of the similar title that we put out with Harvard Business Review about 6 or 7 years ago, also called Think Big, Buy Small, which is a step-by-step book on how to buy your own small business, kind of a roadmap, if you will. So those would be two suggestions I'd make.
Agree with both of those. I like them both.
I guess you could also apply to the Harvard Business School, and then you'd get to come in our classes. But that's
a long route.
Exactly. I'd do the first two things first. Yeah,
that's a long route.
It's great that people now can listen to your podcast and learn more from you. I would love to talk to you more about liabilities because we got to it at the end and I think it's a big topic. I think that there's just so much more to discuss on this topic. Thank you so much for being here. I appreciate your time and everything you shared today.
Thanks for having us.
Thank you for having us.
For everyone watching and listening, thank you so much for spending this hour with us. And I'm looking forward to connect with you all next time.